Economists and investors are bracing for another aggressive rate hike from the Federal Reserve today.
That's right. The expected move would mark the fourth rate increase this year. For the second consecutive month, the Federal Reserve is expected to raise the federal funds rate by 0.75 percentage point. This action would bring the benchmark interest rate to the highest it's been since the summer before the COVID-19 pandemic. Stacy joins us now. She's the Director of Portfolio Strategy for Optimal Capital. Frances, welcome. Great to have you with us. So until last month, the Federal Reserve had not increased interest rates by 75 basis points since 1994. So why is it expected to do this for a second consecutive month? And is there any evidence the previous hikes this year have had any impact on inflation?
Well, certainly they've had an impact on inflation. I mean, you have food prices have fallen off of a cliff. Some commodities are even in sort of the crash zone, which is plus 20%. You've actually had oil and gas back off, and gas prices are coming down. But most of those commodities that are contributory to the CPI are coming down. Now, what you have that's a little bit unfortunate is you have a lag. So if oil prices and gas prices and diesel prices are coming off, it takes 1 month to see that in CPI. So CPI actually lags that. The food takes about 4 months to see in CPI. Used cars, which was a huge component during the pandemic to inflation, they have also fallen. It takes 2 months to see where that recalibrates into the CPI number. Onerously, owner's equivalent rent, which is a large portion of CPI, around 30%, takes 18 months. So even if that falls down, it takes 18 months to be in the CPI component. Importantly, what you were saying is that they haven't done this in a while, and why are they even considering to do it again? If we take Jay Powell's last press conference, he said that he's going to be paying attention to headline inflation. That's CPI. So because these prices are actually falling, but because there's a lagging effect to CPI, then the Fed is going to remain very hawkish.
So you're saying these prices are actually falling, but they haven't been included. The lower rate hasn't been included in what we're seeing in the consumer price index yet. And the Fed is basing its policy on the current number, not necessarily the anticipated number?
Yes, that is exactly what Jay Powell said in his last press conference. And the other thing that he said, which is going to be interesting to juxtapose what he said in the last press conference, given that it was only a month ago, to this press conference. But the thing he said in the last press conference was that after some slowing, they saw an uptick of economic activity, sort of coming into the second quarter. So the thing is that I don't know if he can really say that now, given that we have a plethora of economic data, including pending home sales falling pretty dramatically this morning due to rising rates. So I think it's going to be very interesting, and economists are going to be parsing every sentence from last meeting and every sentence from this meeting. I think he's going to try not to make it too different. He has the challenge of trying not to be dramatic because markets pay attention to everything he says. Mm-hmm. And he's in a difficult position. He really can't back off of the hawkish narrative because markets will anticipate his pivot long before he mentions it, and they will start easing financial conditions again. And that's the antithesis of what he's trying to do in order to fight inflation.
Now, Frances, there are economists who don't think we are in a recession yet, but they fear that hiking interest rates too quickly could lead us into a recession. What's your take on that?
Yeah, so it's very interesting. The quintessential debate around recession. What is the definition of a recession? It's become very semantical. It always sort of was this negative 2 quarters in a row of negative GDP. Okay, so tomorrow, the second quarter GDP comes out, and the first quarter, we were negative 1.6%. So tomorrow, it's estimated that we're going to be just kind of barely positive, maybe 0.3%. We don't know what that number is going to say until it comes out tomorrow. If that is negative again tomorrow, that's the quintessential definition of a recession. Now, the other broader definition of a recession, which is going into this sort of semantics debate, is that do you see a broad economic slowing across a number of sectors? And actually, I think we're starting to see that. So from my point of view, we are already in recession. And the reason is because the 75 basis point hike from last meeting has not been fully recalibrated into the system, let alone what is expected to be a 75 basis point raise in this meeting, and it's going to take months to calibrate the system. And when you think about credit cards where interest rates are going up, adjustable rate mortgages where interest rates are going up, you're not going to see people defaulting on that debt for maybe 30, 60, 90 days. And so you're not going to know when you're doing these large moves all at once, you're not going to know how much was too much. Was it the first 75 bips that pushed it over the edge, or was it the second? And so that's the thing. And that's where there's a probability that they could make an error, and maybe they don't, but we just have to wait and see.
Yeah. All right, we'll have to look for both those markers and see what the numbers are when they come out. Frances, Stacy, thank you very much.
Thank you.